Sorry about cutting the video earlier. Something came up. So I think the last place where I stopped was accrual accounting, and just comparing it to cash. Right now, I think I'll make separate video. I think it's better if I just like split it up by videos, going in order, because accounting is a pretty dense concept in my opinion, especially for this stuff. So in this video, since we already talked about the basics of what an income statement does, balance sheet, cash flow, right now we're going to be talking about the income statement line by line and how it actually may look, or how may it be presented in an interview, right? So you have your income statement, right? Your income statement is otherwise known as a P&L, your profit and loss. So your P&L. So here, super simple, start with sales, you subtract any expenses or cost until you reach your profit at the bottom. That's it. You end up with your net income, right? But there's a little stuff to account for here and there. So let's talk about that. So you have your revenue. You always start off with the revenue. Revenue is your first item, your sales, right? And this is going to be, let's just say 1,000. What this is basically all the money you earn from selling your goods or services. This is your top line, $1,000. This is how much money you made from selling your goods or services. That's it, $1,000, right? Then you subtract your COGS. You may be wondering, you may be asking me, like, what is COGS? What is that? Super simple, it's just an abbreviation, cost of goods sold. It's pretty much in the name, but it's basically the direct cost of items that you sold. So, for example, your materials, your factory labor, anything that's an expense to you when it comes to the products that you've sold. And in investment banking or accounting or anything, it's just good practice in an income statement. You're not going to write minus 400, for example. Say 400 is the cost of goods sold, right? You're going to put that in a parentheses. You're going to put it as 400. So that's what that is. And then once we subtract this out, you get your gross profit. This is your gross profit. And it's going to be $600, right? And this is basically what is left to cover everything else. And say someone asks you, hey, tell me what is the gross margin. And you may be wondering, well, how do you find gross margin? Very easy. You take your revenue and you divide by your gross profit, and you get your gross margin percentage, how much ever that is. Okay, we're ended up at gross profit now. You may be wondering, what do we do now, right? Let's subtract out something called OPEX. OPEX is basically your operating expenses. So this covers SG&A, anything that has to do with running the business, salaries, rent, marketing, administration stuff. You're going to basically subtract that out. Say it's like $250 for your operating expenses. And usually under OPEX itself, it's going to be SG&A and R&D. But say some people do split it up here and there. I'll just do it like that. So say you also subtract out your research and development, because it does go under your operating expenses at times. But at the end of the day, it is an expense, and we have to subtract that out. And say it's $30, you subtract out the 30. You subtract out your D&A. What is D&A? Depreciation and amortization. Basically what this is say that you have a asset or something that is depreciating in value. Basically you're going to have to subtract that out because it's a non-cash expense. D&A is a non-cash expense. It can't be having like a cash and a liquidity value, because say you buy a car right now for $30,000. In 5 years, it's not going to be worth $30,000. Maybe it'll even be worth like $12,000, right? But you're not going to be able to sell it. It just depends, because it's a non-cash expense. And you're basically spreading the cost of long-lived assets over their life. And here, no cash leaves. So that's what your D&A is. Subtract out, say your D&A is $20. And if you do all of this stuff, you're going to end up at something known as your operating income. Your operating income. Operating income is otherwise known as the eraser is too big. Okay, operating income. Honestly, let me just delete this right here. It's your EBIT is what that is. EBIT, operating income. Okay, so what is EBIT? EBIT is your earnings before interest and taxes. Because on your income statement, you're going to be subtracting out your interest, adding back any interest that's owed to you, subtracting out your taxes by multiplying times 1 minus your tax rate, and you're going to end up with your net income. So you're ending up with EBIT right now, and EBIT is going to be $300, your operating income. Operating income is basically your profit from your core operations before you're talking about any financing the company's doing or any taxes, right? So you have $300 in EBIT. Once we have our EBIT, we're going to come down and we're going to subtract out our interest expense. Because this is earnings before interest and taxes, so we have to subtract out our taxes and our taxes and our interest, right? So let's subtract out our interest expense. Say, for example, the company has some debt, and this is basically the cost of the company's debt. You're basically paying that money off to someone else, and this is where kind of capital structure also starts to tie in. We'll talk about that a little later, but this is your interest expense, and let's just say that's $40, right? We'll subtract that out. Here, in the same area, we also add back any interest owed to us. So any interest or other income. Say the company has some other income coming in from like a subsidiary company, anything. So any other income, interest earned on interest earned on cash and other non-core items. So basically here we would be adding that $10, for example. You earn an interest for yourself or for anything that comes from other income. And if we do this, you're going to get your pre-tax income, or otherwise known as your EBT, earnings before taxes. This is basically your profit before the government takes a share, because in the perfect world, sure, there won't be taxes, but here in this world there are taxes and we do have to deal with that. So we always have to account for taxes, and that's super important. A lot of people tend to forget. So you're going to come down to 270 right here. Super sorry for the Apple Pencil. I'm not a big fan of it. I'm just using it to help write. But $270 is what you get profit before the government takes a cut. Split this up. So here you're going to subtract out your income taxes, right? Your income taxes, say it's at, you always ask your interviewer, hey, before I walk you through the 3 statements, let me get a quick, what tax rate should I assume? Say the interviewer says 25%, right? Basically here you would take your 270 times 1 minus your tax rate, and you see how much tax that is. So that's 68. This is the tax owed on pre-tax profit. You have your 68, and then if we subtract that, you're going to get your net income. And that's our last line item, your net income. And your net income here is going to be $202. This is basically what this is the profit belonging to the shareholders. So that's basically what this is. And you may be wondering, hey, I've heard EBIT somewhere. If you've been anywhere around finance, EBITDA is like super common. Is a super common term that's just thrown around, right? Bankers kind of just live on EBITDA, in my opinion. Basically, what EBITDA is. Let's erase this now. What is EBITDA, right? So let me go ahead, take this off. EBITDA. EBITDA is basically your earnings before interest, taxes, depreciation, and amortization. In our situation, we had EBIT, which was our operating income. But say you wanted to go from EBIT to EBITDA, all you do is you add back your D&A. How much ever we subtract out, I think it was $20. Here EBIT is basically, I think it was 300 and the D&A is like 20, so the EBITDA is 320. You may be wondering, what is EBITDA's significance, right? EBITDA basically strips out a couple of things. Number one, it strips out your financing choices, how you're financing different decisions in the company, right? Whether it's through annual payments or whatever it is, your financing choices. You're also taking off your taxes, right? That's pretty obvious, just taking off your taxes. And number three, you're taking off your non-cash charges, because your D&A, your depreciation and amortization, are non-cash charges. So it ignores taxes actually paid, working capital swings, and money spent on specifically things like equipment, for example. And I think a common misconception is comparing cash flow and EBITDA. EBITDA is not cash flow, and that's a concept that's pretty misunderstood, but EBITDA is not cash flow. And we'll talk about the cash flow statement after as well. So that's it for this video. Super short, just keeping it simple with the income statement. I'll see you in the next one for the balance sheet.